Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, chief strategist at Interactive Brokers, to discuss how traders are positioned for volatility in December. Steve, it's great to see you as always. Before we get into how they're positioned, I want to get your reaction on the job numbers that were released this morning.
Well, great to see you again, Jill. The numbers this morning were somewhat surprising, though they shouldn't have been out of left field surprising. And I think that's kind of why we've mellowed our reaction as the day went on. These numbers are hard to get right. You're talking about a few thousand jobs in the course of an economy with 100 million people plus employed. Still, the 263,000 was a jump, as was the revision. I think the market was actually looking for something less than 200,000, the so-called whisper number. And I think the key here also was the fact that wages went up much faster than expected. 0.6% on a month-over-month basis. 0.3 was expected. Last month was 0.4, was revised up to 0.5. That doesn't help the Fed's fight against inflation. It's great if you're getting a raise, mind you, and you're one of the many people who, and if you're one of the many people who are, that's great. And this is where you get into the conundrum of the Fed fighting inflation versus a robust employment market. Let me just put out there that, the JOLTS numbers that came out earlier this month, there's still 10 million jobs that are left to be filled. That's well above the pre-COVID record. It shouldn't come as too big of a surprise that companies want to fill these jobs and they have to get people to do it, and they sometimes have to lure them in by paying them more money. That's what's out there, and that's a good thing for the economy, bad for inflation.
Yeah, let's do some chart work here, Steve. As for volatility, markets appear to remain relatively sanguine here.
Yeah, I mean, I think that the general opinion in the market seems to be that, call it a year, except we don't know that we can. We certainly have a Fed meeting coming just before quarterly expiration on the 14th with expiration on the 16th. But the market, we do a lot. Remember, a lot of the volatility measures, VIX, VolQ, a lot of the ones that we look at normally tend to look out 30 days. And those 30 days include 2 weeks where really nothing really happens. And so I think the market's kind of looking past it, figuring, let's call it the fix is in. I see you put up a chart in the meantime. That is sort of the spread between VolQ and VXN. One thing that, people who've watched us talk before know that I bring up from time to time. That number is more or less near its lows. And remember, what that tells us is VXN includes the wings, so to speak, out of the money calls, out of the money puts, et cetera. Whereas VolQ is focused around the money. This is telling us that people are really not looking for options that are outside the realm of that money. They're not hedging the downside. They're not particularly going after upside calls either. I think that there's just this hope for stasis into the end of the year.
Yeah, and our next chart for you, Steve, implied vol remains low compared to recent historical levels too.
Exactly. When I start to look at, the 7-day, the 20-day vol, that chart has the 20-day vol. The 20-day historical is around 35. And think about it. We've had some big moves, and particularly intraday moves, but we've got some big moves over the recent history. On the other hand, the implied vol is in the low 20s. And so what we're seeing here is another dislocation. Basically, the market saying that, okay, we know things have been volatile, but we don't expect them to stay volatile. And, so we're just not really going to bid up for volatility right now. You can argue that this might be complacency. I would say if we weren't looking at the seasonal factor of December, I would start to really think that this was true complacency. It's tough to weed out the seasonal from the goings on the ground, so to speak.
Yeah. And Steve, our last chart for you, to your point earlier in this segment, it seems as if after today's payroll reports, traders are expecting a bit more vol coming into the FOMC, and to your point, options expiration right after that.
Yeah, they were very calm going into the Fed meeting. I think today woke them up a little bit, saying, okay, maybe there's something that's going to come out here. On the other hand, they're still not particularly too nervous. One thing to keep in mind is we've got a greater consensus about a 50 basis point hike at the next meeting. But I think with the uncertainty that might come out regarding the Fed's comments, regarding the dot plot, and again, reminding ourselves that seasonality tells us that liquidity tends to dry up as we get toward the end of the year. I think that's why you started to see a little bit more volatility being priced in around that mid-month.
All right. Appreciate the insight as always, Steve. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.